Here we are, episode 99, 1 from 100. So stoked about that. I'll talk about that a little bit at the end of the show. But for this podcast episode, I kind of want to dive into housing. Surprise, surprise, right? There's a lot of naysayers out there about the housing market. I've done numerous podcasts about this, but the data continues to keep coming in. One of the things that we know is that the housing market is one of the strongest markets that's still out there in the inflationary environment that we're in right now. And I think that the data that just came in from July, so yesterday on September 26th, we've got multiple indexes that came in for the month of July. The FHFA, which is the Federal Housing Finance Agency index, came in, which measures the pricing of all homes that are being financed. And as far as appreciation route, it shows the appreciation of the homes, so the price points of the homes that are being financed. And that's a real critical component here. And then the second index that we have that comes through on there is going to be the Case-Shiller index, and that's brought to you by the S&P. So it's considered the gold standard, if you may, of measuring home appreciations during the month of July. And I think what's interesting about that is it had been down a little bit previously. I think those 3 last consecutive months have been a negative number, very small, less than 1%. But this month it was up. And I think that what's interesting is that the Case-Shiller index, it actually measures all transactions. So you get financed and you get cash transactions in there. And one of the things that we had been measuring over the last 3 months was that cash is king, right? So with cash being king, there was this thought that the index should be lower, because with cash, you can negotiate a better deal with someone than maybe a person that's trying to finance property. And on the FHFA, it had been continuing to keep going up and up. And the argument was, when you have someone financing, they're not as equipped, if you may, to strike a deal with the seller that doesn't necessarily have to sell the property, pending there's no like major critical life component, change, divorce, death in the family, loss of job, etc. They're just selling their home to see what they can get. You're at the mercy of the seller and the price point associated with that you're necessarily not going to get the best of deals compared to someone that may be paying cash. So that was the logic behind what we were tracking over the last 90 days. But what we know now is that both indexes are up. If you go back into 2022, especially on the FHFA, the index, it had been off a little bit in the back half of 2022. It was up pretty high, 9% on the first half of the year of 2022, and then fell down 3% on the back half. You got a net gain of 6% on the year. But here in 2023, we've already made up all of that ground and then some, with a projection of somewhere between 5 to 8% on the year. Think about this. Homes that are selling under contract, under financing terms and conditions, are gaining 5 to 8% appreciation depending on your region and your market. That's insane considering where the rates are right now. We're at 23-year high on rates, and yet we're still seeing that kind of appreciation and upward price points. The reason that's important is that shows you the market's not going backwards. We continue to talk about that even with all the things being stacked against buyers right now, we have higher rates. We have some of the lowest levels of affordability, or what's coming out right now. We have multiple offers. It is said right now that each contract that is being accepted, each seller is being presented, on average now, it could be different in your market, it could be different in markets across the country, but on average, 3.7 offers per home being sold. That is demand. That is absolute demand in property. We keep talking about this demand. I'm not going to go on about it because, I repeat myself on this, but I've talked about this pent-up demand that's happening. I think at 3.7, we're not even scratching the pent-up demand. This is just the demand that's filtering to the surface that says, hey, listen, I'm going to take advantage of the market now. And you may be looking at this going, cute, what in the hell do you mean take advantage of this market? Rates are at, 7.75 right now as I'm talking, is what bankrate.com is projecting. But advantage of the market is the ability to buy in now before that appreciation goes from 5 to 8% to much higher when these rates drop. We talk about this, that when these rates drop, and again, when is the question, not if, when they drop. When these rates drop, and if you listen to our last episode about the dot plot map, you probably saw that we showed the different forecasts in there as we were breaking down the dot plot map. So there is a significant notion that over the next year and a half, we're going to see them drop. When they drop, what kind of frenzy is that going to create? Are we going to go from 3.7 offers to 10 offers to 12 to 37? It wasn't that long ago in 2020 and 2021, we were getting double-digit offers per property. You remember what the fear of missing out is? It was a real thing, and that people were jumping in and offering price points. Contingencies were being waived. Appraisal gaps were being put in there. You know it. You saw it. You lived it. Whether you were a buyer, whether you were a seller, whether you were an agent, whether you were a mortgage lender. I mean, it was pure pandemonium. Think about what that's going to look like this time around, maybe in 2024 late, maybe in 2025. What is it going to look like when those rates drop down again? We're in the highest rate environment in 23 years. We're in an inflationary market right now, and we're in a fragile financial system. And yet the home prices are going up. And they're continuing to rise. Granted, I realize there's sub-markets where it may be flat, maybe even gone backwards a little bit. But that is not the case of what we saw during '08. It's not the case that we saw during '09 or 10. Obviously, it was brought on by real estate, but we saw significant losses during that time. And when I take a look at our markets and where we are, it is much different. And now that the Case-Shiller index, again, which is considered the gold standard, has actually now turned to an upward trend, this brings on a really significant question that, okay, is cash now having to compete with other cash offers? Or is cash having to compete with other people that have better financing terms and conditions than their cash offer? And is the market actually getting to a point now to where cash may not be king in that particular scenario? Or are sellers, which I think this is what's happening, I think sellers are going, you know what? I don't have to sell. Not only do I not have to sell, I'm very comfortable where I am. And unless you give me this price that is 5 to 8% higher than what I'm expecting, that's key, because we know expectations of sellers sometimes can be higher than what the market tends. I don't need to sell. And not only do I not need to sell, I'm not going to sell. So I think that that's important here, because I think that's what this index is actually showing and representing to us right now in this particular marketplace. And for me, that's very interesting, especially considering where we are in the market. So it's interesting to me that the Case-Shiller is the gold standard. Because when I take a look at the FHFA index, what's interesting about that FHFA index, that is the index that the agencies of Fannie Mae and Freddie Mac look at to determine the conventional loan limit. So let me break this down for you here. Right now, the conventional loan limit is $726,200. When I first got in this business years ago, that number was $256 and some change. And of course, that was 22 years ago. But it eventually got up to $417,000. It stayed at that number for almost 10 years before it moved. Why? Because this index, this FHFA index, did not show an appreciation rate that garnered the agencies to move that conforming loan limit up. This is on pace now to be the third year in a row for it to be up. Now, keep in mind, last year it was up 6%, a flat 6%, and some change, right? But it was up 6%. The conventional loan limit was raised significantly on that 6%. If we are on track to be between 5 and 8%, this conventional loan limit could be well over $750,000, $775,000 going into 2024. And it's all based and it's all predicated on this index. And that is why I think this index is extremely important to follow and extremely important to look at. And that announcement will be coming in the month of November. And that's because when we get these indexes, they're always 2 months rolling. So when we get September's data, which will be in November, that's when they make the announcement of the increase in the FHFA loan limits for conventional Fannie and Freddie. And then HUD follows. Now, those numbers are different from HUD, obviously, because those are per county basis and they're based on AMI, much different things than, well, not much different, but the actual loan limit is different than the loan limit for conventional, but it all starts with this FHFA. And I do think it's interesting we refer to the Case-Shiller as the gold standard, and I think it's the gold standard because it's S&P and it's got a lot of credentials and it measures cash and it measures things that FHFA don't. But don't sleep on the FHFA index because that determines your loan limits and that determines what the conventional market is going to adopt as new loan limits moving forward. And again, just based on historical context, last year, FHFA was up 6%. You know, it started high at 9, fell off 3% in the second half. So the year ended at 6% appreciation. And we got a significant jump. We got over a 70,000, I think it's like almost 80,000 jump to conventional loan limit the next year. What happens again if we're at 5 to 8% on this one? That's going to be really interesting because, again, we could be very close to that 800,000 mark if we stay on the pace of what we're doing right now. And if history continues to show and repeat itself as it's done over the course of the last 2 years, I think we could be seeing a much higher conventional loan limit again this year. And that's why these two indexes are so important to watch. So as we recap the show here, Case-Shiller. It involves the cash transactions, and that's what we've been tracking over the last 90 days. And to see that number go up now in a positive manner, not a negative, is representing, is cash king, or do we have sellers that are holding their grounds, or do we have sellers that just don't need to sell right now because, quite frankly, they're locked in to that lock-in effect we've been talking about for so long on here. And then also on the FHFA side of things, that measures finance transactions, and we're starting to see all of those numbers go up, and we're starting to see 5 to 8% forecasted for the remainder of the next 2 months. And again, if we get that number, what does that mean for the conventional loan limits? It could mean increases in that to help offset some of the higher home prices, so the affordable financing can be done on that. So as we turn the page here, next episode's a big one, guys. It's our 100th episode. If you like what you're hearing, share this podcast. 5-star review it on Google, Amazon, Spotify. Leave some comments. We love it when you guys get it. Matter of fact, some of the ones you guys have been leaving is going to lead to our next couple episodes, 101 and 102. Some of the comments you're leaving for us on there, it's great feedback, and we're definitely getting ready to dive into that stuff. But again, check us out on our YouTube channel. There'll be some graphs on there at What's Your One More with the number 1, and our socials at What's Your One More with the number 1. And as we go into the 100th episode, man, it's a special one. We got a chance to sit down with Mr. Maurice Hennessy himself, and he is an 8th generation Hennessy, and he's the last one. And what's special about this is Charlie and I went and did a mobile podcast with him. And when you think about the brand that Moet Hennessy combined to make, it encumbers a ton of stuff, 27 different brands, matter of fact, as we find out. Whether you drink any of that or you drink it all, the appreciation of an icon sitting in front of you whose family date back to the 1800s in making one of the oldest liquors and one of the oldest spirits known to man is pretty darn cool when you think about it. And he shares some really great stories, and he had one heck of a personality, and he cracked us up throughout the show. And he was kind enough to not only educate us about the cognac and the Hennessy brand, but also bring some very rare Hennessy to the show and walk us through the journey of what that was and what it took to make that and how many years went into that particular spirit. And we were joined by Mark Nicolosi, who is the SVP of North America for the Moet Hennessy private brand. And then we had Rhonda on the show as well, who was so kind to grace us with her presence, super enthusiastic about the brand, super enthusiastic about the Moet Hennessy private collection. And she was there representing the Moet Hennessy private client division of London and Paris, as well as North America. It was just a really special moment, and it's something that I can't describe. I can't wait for you guys to hear it. But till the next episode, guys, check it out. Episode 100 is pretty amazing at What's Your One More.
I got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live, so I put my all into it, yeah.